All right, guys. Today we're talking about the one thing the market absolutely hates. What's that? Losses? No, it's maths. Specifically, government maths, which, as you know, is basically a form of creative writing. Everyone talks about inflation, employment, Bitcoin, gold, AI stocks, but no one really actually wants to talk about the monster hiding under the bed, and that is the global debt bubble. And trust me, guys, this thing is actually uglier than the chart of Luna after 2022. As a trader, I look at one thing: who owes what and who can't pay it. And right now, it looks like the entire global economy is running a giant leverage trade without a stop loss. So, what's the setup? How did we actually get here? Well, gonna have to do a little bit of a history lesson. So bear with me. Let's rewind a little bit. How did we end up with a debt mountain larger than the GDP of planet Earth? I kid you not. Well, it started out very simply. Governments realized they could borrow money. And nothing bad happened at first. It was like giving a teenager a credit card with no limit. At first, it's just I'm just going to buy some petrol. Then it's a PlayStation, a few games here and there, not really a big problem. Uber Eats, and suddenly, bam, the limit's gone. 2008, massive stimulus. 2020, massive stimulus squared. 2021, massive stimulus to the power of meme stocks, if that's a real exponent or an order. We created a world where interest rates were zero. Money was free, and everyone behaved like leverage was a human right. So what happened? Obviously, this followed. Stocks pumped, crypto mooned, real estate doubled, bonds soared, everything went up except responsibility. The problem. What is the problem? Well, high rates and high debt. The reality is this. We have a man who walked in the building. His name was Powell. And with a fresh rate hike cycle, he was like, hey guys, no more party, cheap money era is over, go home, right? You don't have to go home, but you have to get the hell out of Dodge here. This is the part no one really wants to say out loud, because high debt plus high interest rates equal a catastrophe. When rates were at zero, there was really no reason to rein in the punch bowl. Servicing that debt was basically free. But what about now? Well, now we've got the US paying over $1 trillion a year just on interest. Imagine if that was a domestic liability, like your home's liability. That's more than they spend on defense, more than Medicaid, more than anything except boomers retiring, right? It's like maxing out your credit card, and now the bank wants 25% APR. They're like, oh, that balance-free transfer window's over, that interest-free window's over. Now you got to pay everything. And what happens when the government has to pay more interest? Well, they borrow more to pay it, and then more, and then more. It's like a Ponzi scheme, but with flags. We can't do that as an individual, and for good purpose. But hey, the government can, especially the United States government. So why does this matter to markets from like a trading perspective? Because as traders, here's what we actually care about. Debt equals higher yields, which equals tighter liquidity, slower growth, and falling risk assets. You don't really need to be a PhD to understand that. You just need to have been margin called once or twice before, right? The dreaded word margin call, the dreaded phraseology. You know, when government issues more bonds, the yield spike. When yield spikes, stocks puke. Bitcoin behaves like a leveraged NASDAQ ETF for like 2x the vol or more. Real estate stops breathing, corporate credit gets torched, and liquidity always just dries up like an altcoin bear market. And then you're like, oh, who's swimming naked? And by that time, it's too late for anything. So this is why Bitcoin sells off on bad bond auctions. This is why gold pumps whenever yields drop. It's the same reason that Nasdaq starts to dance like a monkey to Powell's voice. They're all correlated. It's all related. And it's all about this infinite debt loop. So I think there is actually a dirty secret in this market. And the dirty secret is probably what most analysts don't want to admit. We can't actually afford high interest rates. Not in the US, not in Europe, not in Japan, not in emerging markets, not your cousin who bought Solana at $250. Not me. No one can actually afford it, right? Everyone is just over leveraged, and they're re-hypothecating, they're reprinting, they're re-borrowing. The entire financial system is now actually dependent on low rates, cheap liquidity, and money printing cycles. When Powell says higher for longer, what he's actually saying is, I hope nothing blows up because we have no plan B for it if it actually does. But hey, we're going to stay data dependent. I'm going to pretend as it keeps going on, because the longer I fuel it, the longer I have to pretend, and the longer I don't have to face up to reality. And historically, something always blows up. It's either the banks, it's either the bonds, the pensions, the shadow banking, the sovereign debt. Something always cracks first. This is why traders like us need to watch bond markets more than the stock market. The bond market is the market. It's the spine. Stocks are just like, I don't know, the vascular system, or stocks are just the vibe. Stocks are just the mood. But the bond market is the system. So what actually happens when that debt cycle breaks? Well, I'll tell you what happens. The debt bubble pops. You want those possibilities? Here's a few on my list of doomsday scenarios, right? I don't mean to be like a doomageddon or like a apocalyptic pornography, I don't know what you would call it, but this is what really happens. We get sovereign defaults, bond yields, they start to spike uncontrollably, central banks, even with like great orators like Powell, start to lose control, stock enters multi-year bear markets, housing implodes, currencies devalues, governments panic print, unemployment skyrockets, and when panic printing happens, what happens? Well, Bitcoin goes nuts. Gold goes nuts. Anything with scarcity becomes king, like real estate, Bitcoin, anything that can't be rehypothecated and can't be printed ad infinitum, ad nauseum. It's not that crypto loves the chaos. It's that fiat really hates reality. I like that. That's actually quite cool. It's not that crypto loves chaos. It's that fiat hates reality. But I like that. That's actually quite cool. Why does no one talk about it though? Why is everyone hiding it like under the mattress? No politician really wants to explain debt because the solution is basically, hey, I'm going to stop spending money that we don't have, and we all know that's never happening. Or no economist really wants to explain it because the entire modern economy is built on unrealistic leverage. And the public doesn't want to hear it because it's complicated at the present. The financial equivalent of like eating your spinach and your broccoli. But I like spinach and broccoli, to be honest. But like, as a trader, what's the key takeaway on this? Because there's one truth here, and let's do it from a trader's POV. We are living in the biggest debt bubble in human history. The only question is how it pops. Not if it pops, but how and when. And whether the Fed cuts before or after the fireworks. You can ignore it, or you can prepare for it. When debt gets this unsustainably high, central banks do the same thing. Every single time. They print, they cut, and they pretend they planned it. And that moment, the liquidity flood, is when assets with real scarcity explode. I'm talking Bitcoin. I'm talking real estate. I'm talking certain crypto coins. I'm talking quality equities. I'm talking real estate. Cash flow companies with low leverage. Everything else, let's just say, if it swims like Luna and it quacks like Luna, well, you probably know the rest. This has been the House of Trade. I'm Justin Benton. Like, share, and subscribe. I don't mean to bring the depression to you, but it's just a dose of reality. And hey, I like to greet everything with a healthy dose of skepticism and a dollop of reality. Ciao for now. See you in the next time.